Good morning and welcome everyone. Thank you for joining us today for our Winter Tax Forum here at Williams Mullen. My name is Jenny Connors. I am a partner here in our Richmond office, and I am joined by several of my colleagues, Kyle Wingfield, Farhad Aghdami, and Derewenda, all of whom are also partners on the tax team and also located in the Richmond office. Before we get started, I wanted to go over some housekeeping items. At any point during the presentation, you may submit questions by using the Q&A button at the top of your screen. We will address questions as time permits. If we don't get to your particular question, please know that we will follow up with you after the presentation is over. Also, if you are having any audio or technical problems, please use that same Q&A button and we will try to resolve them as best as possible. This program has been approved for 1 credit hour of CPE. And our application for 1 hour of CFP credit is still pending. This afternoon, you should receive an email from us with a certificate of attendance for CPE, and we'll send a separate email once we get approved for CFP credit as well. Please note that we're going to be using the polling feature today as part of our program. We hope you enjoy this as a way to interact with us, and we look forward to seeing your answers. If you are using multiple monitors, please note that the polling window may appear on a different monitor than where the Zoom meeting is displayed. So just keep that in mind as we're asking the questions and using polling to certify attendance as well. So let's go ahead and get started with my section. As you can see, this is the agenda for today, and I will be starting with general tax updates. So up first, we're going to talk about the Consolidated Appropriations Act of 2021. This was the act that was signed into law at the end of 2020 by then President Trump. This is our second coronavirus aid package, probably not likely to be our last. This was a $900 billion package. As part of this package, we got a second round of PPP financing. I believe the amount is $284 billion. This second round of PPP seems a lot more targeted towards small to mid-sized businesses as opposed to some of the larger businesses. I think this one has a cap on employer size of 300 employees, and it also has a maximum cap on the amount of PPP loans that you can take, and the max is $2 million as opposed to $10 million for the first round. So again, really targeted towards the smaller and mid-sized businesses. A benefit that all PPP borrowers got, whether they took the first round of PPP or they plan to take the second, was some clarification on how the PPP program is going to be handled by Treasury and the SBA. So one important clarification that we got had to do with the loan forgiveness percentage. And for those who have dealt with the PPP, you know that to be forgivable, you have to spend at least 60% of the PPP loan proceeds on covered expenses, which are largely payroll expenses. And what this act did was it expanded the amount of covered expenses to include not just payroll, but also some additional expenses that companies may be seeing at this point. So if you had to invest in more PPE, personal protective equipment, to get your employees back to work, those are covered expenses that you can count toward that 60% threshold. Also, importantly, software expenditures or other things that you had to purchase to increase your work from home capability for your work from home employees. Some of those covered expenses will be included as well. So things like WebEx or Zoom likely would be included now in that 60% threshold. So that's, again, applicable to first round borrowers and second round borrowers. So that was an important clarification. I think the most important clarification under this act that we got for the PPP program had to do with the deductibility of expenses that are funded with PPP loans. And in this act, Congress really walked back the IRS Notice 2020-32 that came out last year, where the IRS said to the extent that you are paying for otherwise deductible expenses with PPP loans that are forgiven, you cannot also deduct those expenses. And I think everyone was up in arms over this, not reflecting the congressional intent of the PPP loan program. So sure enough, Congress clarified in this act, they do intend the double benefit. They do intend for those expenses to be deductible, even if the PPP loan is forgiven. So that was a big win for businesses, both who, again, took the first round of PPP financing or intend to take the second round. And Congress actually took it one step further than that and said, there is really no reduction in any tax attribute of a PPP borrower. So this is not intended to serve as a detriment. It is truly intended to serve as a benefit for businesses that are struggling as a result of the pandemic. So that was important clarification on the PPP program. While we saw a little bit of a contraction and limitation of the applicability of the PPP borrowers and who could use that benefit, we saw an expansion of the ERC, or the Employment Retention Credit. And some of these expanded provisions in the ERC make it a lot more usable, and I think we may see more and more employers try to take advantage of the ERC in 2021. What they did was they increased the maximum amount per employee that you could claim as the credit. So for all of 2020, the maximum amount was $5,000 per employee. For the first 2 quarters of 2021, the maximum amount of the credit that can be claimed, again, per employee is $14,000. So that was a big jump. They also expanded the pool of employers who could qualify for the ERC. So before, to qualify for the Employment Retention Credit, you had to see a drop in gross receipts of 50% or more, comparing that to the same quarter in 2019. And under this new round of the ERC, you only need to see a drop of 20% in gross receipts, which, as you can imagine, is going to just loop in a whole lot more businesses and employers into qualifying for the ERC. It's also available to employers who weren't existing in 2019. So there are different qualification measures for new businesses and new employers. And they also clarified that you can qualify for the ERC and a PPP loan so long as they are covering different amounts. So in other words, you can't double up on the same expenditures for PPP and ERC. They have to be mutually exclusive in that respect. So again, this is really an expansion of the ERC. You may see borrowers who previously took a PPP loan who now maybe are shifting to the ERC for 2021. Also in the Consolidated Appropriations Act, we saw the extension of some credits that were otherwise set to sunset. So the new market tax credit would have sunsetted December 31st, 2020. It was extended for another 5 years. Perhaps no surprise, but still they did extend that. One thing that was a little bit surprising, but a pretty big benefit, was the extension of the solar ITC credit percentage at 26%. So starting in 2019, well, 2020 really, in 2019, that credit percentage was 30%. In 2020, the credit percentage dropped to 26%. And without this extension, the credit percentage would have dropped in 2021 to 22%. And what the Consolidated Appropriations Act did was that it extended the credit at a 26% rate for another 2 years. So through the end of 2022, the solar ITC should stay firm at that 26% rate. So we have a lot of solar clients and developers that were very excited about that credit extension. So moving on, another thing that we have seen recently was the final carried interest regulations. And these regulations relate to Code Section 1061, which was enacted as part of the Tax Cuts and Jobs Act. And this restricts long-term capital gain treatment for certain applicable partnerships. And APIs are generally defined to be partnerships that are held by a taxpayer or related person, and they're granted in connection with the performance by that taxpayer of substantial services to an applicable trade or business. In this case, applicable trade or businesses are generally partnerships that engage in investment-related activities. So you have private equity funds, hedge funds, but you also have partnerships that invest in real estate, which is how a lot of our clients have been impacted by these carried interest regulations. What it did is the rule essentially takes you from focusing on a 1-year long-term capital gain rate for property or a 2-year holding period for profits interests and extended all these holding periods for long-term capital gains to 3 years if the individual holds or the taxpayer holds an applicable partnership interest. So we waited a long time for any kind of proposed regulations on this new code section. And they finally came at the end of July 2020. I think it was July 31st of 2020, we got proposed regulations. There were a slew of comments and complaints about the proposed regulations, and the final regulations were part of the rush to issue regs that the Trump administration put out right before President Biden took office. So these were issued on January 7th, 2021. And we told you about some of the rules that came up in the proposed regulations. I think there were some notable changes between the proposed regulations and the final regulations. And it, in a way that the final regulations almost sort of eroded a lot of the hold that the statute and the proposed regulations had over these carried interests. So one set of changes came with respect to capital interests and how you identify a profits interest that's held by a service provider and a capital interest. And the proposed regulations had set a really restrictive standard that you had to look to whether or not the capital interest received allocations in the same manner as investors who were non-service related providers. And the problem is that you think about different tranches of investment, priorities, preferential returns, and it was really hard for any service provider to meet that threshold of allocations made in the same exact manner as those investor members. So they pulled that back a little bit and changed that in the same manner requirement to in a similar manner. So it should be easier a little bit to meet that profits versus capital interest threshold. I think one of the bigger things that you're going to see people utilize is the proposed regulations prohibited any kind of capital interest that was acquired with loan proceeds from counting as a capital interest, which would kick you out of 1061. And the final regulations changed that rule, and they said, you can have a capital interest that's acquired with loan proceeds, but the borrower, the service partner, has to be fully liable for those loan proceeds on a recourse basis. So you can't have any kind of non-recourse financing to acquire the partnership interest. But it will be interesting if you see people start taking advantage of this rule to borrow money, acquire a capital interest, and then be kicked out of 1061 and not have to worry about this 3-year hold period. Another clarification that came into play with respect to capital interest is they said, if you're a service partner who has gotten the benefit of a book up or revaluation in your capital account, that book up or revaluation doesn't count as a capital interest. Any unrealized gains will not count as a capital interest. They also had included a provision in the proposed regs that related to transfers to related parties. And this was also came from the statute a little bit too, and the final regs clarified this issue. So one of the concerns was that if you were a profits interest holder, a carried interest holder, and you transferred your interest to a related person, whether or not it was a gain recognition event, would you have to recognize that gain? And the final regulations clarify again that if it's a non-recognition transaction like a gift, 721 contribution, something along those lines that would otherwise result in non-recognition, there is nothing that's going to accelerate that recognition in this statute or in these regs. Importantly, they pared back what's called the asset look-through rule. And this rule in the proposed regulations said, if you are a profits interest holder and you have held your API for a 3-year period, but the underlying partnership didn't acquire substantially all of its assets until after your acquisition period, you look to the underlying holding period of those assets, not the holding period of your API. So if for some reason the partnership didn't acquire an asset until year 2 of your holding period, even if you had held your API for 3 years, you wouldn't have met that 3-year threshold. So this was another issue that a lot of people had, and they ended up completely walking back that rule and substituting it for an anti-abuse rule that basically says your 3-year period will be shifted if for some reason you didn't have third-party capital commitments for at least a 3-year period. So now you're looking at the capital commitments of third-party investors as opposed to the holding period of assets. And they also just included a general broad anti-abuse provision that prohibits any kind of activity that would be seen as a workaround against 1061. And importantly, the thing that we keep coming back to under 1061, both the statute and in the final regs, again, 1231 gains are not captured under 1061. So if any gain is flowing up to the holder of an API as 1231 gain, it's not even included in this provision. So that's going to exclude probably a lot of real estate holders, since the 1231 gain is gain realized on the sale of real or depreciable property used in a trade or business for over 1 year. So that's going to be a big exception as well. So finally, just a quick note on the regulatory freeze that the Biden administration put into effect when President Biden took office. This was similar to the freeze that President Trump used and President Obama before him. And I think George W. may have even used this as well. So this is pretty common practice. He put in a 60-day postponement for any newly finalized regs that had not yet been published. So issued but not published. For any regs that had been published in the Federal Register, he tacked on a new 30-day period of review and comment, which generally when regs are published in the Federal Register, there is an automatic 30-day review and comment period before those rules become effective. There's actually a 60-day period for major rules that have a significant economic impact. The Trump administration used a good cause exception, however, to make a lot of the tax regs that were quickly published effective on publication. So it will be interesting to see if any of those are pulled back through either general rulemaking procedures or the Congressional Review Act. I haven't seen anything so far, but if something were to happen, you do have, as an example, the carried interest regs that were issued on January 7th and published on January 13th. And they were made effective as of the date of publication. So it will be interesting to see what happens to some of those tax regs, if anything. And I think, you know, as a final matter, we've just continuously been updating everyone on our thoughts on an overhaul of the Tax Cuts and Jobs Act or on tax legislation, sweeping tax legislation in general. Certainly with Georgia shifting, it's a possibility, although I do think everyone right now is probably very focused on pandemic relief as opposed to raising taxes. So I think for now, we are probably safe. Janet Yellen, who I believe was confirmed, said the focus will be on small business incentives. She did indicate there would be a raise in the corporate tax rate if their administration got their wish. So we will see what happens down the road. As my polling question, I'm curious to get everyone's thoughts on how likely sweeping tax changes are to be during the Biden administration, whether it's sooner or later. And one thing that was fairly interesting that I noticed, somebody put it wisely. They said basically with the split, it gives any Democrat in the Senate veto power because of the 50-50 split. So even every single Democrat would have veto power over sweeping tax changes. Okay. All right. So it looks pretty split between yes and no, with most people choosing maybe, which I think is probably the choice I would give it to. Just a lot of uncertainty for right now, but I think anything that would happen would likely come later. All right. And I think we have Kyle up next with some state tax updates.
Yeah, thanks, Jenny. Good morning, everyone. Thanks for joining us today. I thought that it'd be good as kind of a preview of what I'm going to go over today is some general updates in the General Assembly, some proposed legislation, and then also a topic that virtually every business is probably having to deal with now with remote workers. One thing that I thought was interesting about what's going on right now with the Department of Taxation is that there's been some turnover. So the appeals process has been taking longer to get through. We've seen more rulings come out from the commissioner's office in batches, as opposed to the trickling that we normally see during the year. We've also seen more taxpayers over the course of this past year just go directly to circuit court and file suit. So that's, and there's been some turnover in the collections department as well. So that's kind of what's going on at the state level. They're still working from home, so response times are slower, pretty much on everything, but you know, they're doing a good job. So with that, I thought I would get into some of the things that are in the General Assembly that may or may not get passed, but since they're in session right now, I thought it'd be kind of interesting to take a look at what's going on. So the first slide is really just the annual conformity statute. That is a conformity, Virginia conforms to the Internal Revenue Code, and every year the General Assembly updates the date of conformity. And so obviously everything that's happened this past year, it seems like it's been 10 years, right? But, you know, with COVID and you know, various stimulus packages, the date of conformity was still stuck from December 31 of 2020, I'm sorry, 19. So this bill would bring us back into conformity. However, as always, Virginia will deconform or decouple from various provisions of the Internal Revenue Code and legislation. In this case, they have, among the other items we're decoupling from, it would be the NOL carryback, the excess business losses, and the limitation on business interest. And the impact statement that goes along with each of the bills that are presented in the General Assembly, they estimate the fiscal impact. They estimate this will save us, and I wrote it down, $665 million just by decoupling from these three provisions. So that's something to watch out for and how it goes forward. And on the next slide, we have, next slide, please. Yes. So this one is an interesting one. I don't know what chance it has to get passed, but it's obviously special legislation for a particular taxpayer, proposing that the banks be able to use R&D credits. So it came out of the Hampton area by Representative Martha Mugler. So she must have a taxpayer down there that this is of particular interest to. And on the next slide, this I think is actually a great idea. I don't know how well it will actually play out and if it'll work. But it's an online portal for taxpayer practitioners to be able to go and do things like, get account transcripts or to upload powers of attorney and that kind of thing. The IRS has this stuff. And I think over the past year, the IRS has gotten really good at it. Virginia, I don't know if this is practical or not. I mean, a lot of their computer systems are older. It would take a lot to make it happen. But as somebody who deals with the Department of Taxation on a daily basis, this would greatly help people like me communicate with the Department of Tax, particularly people working remotely. And on the next slide, this continues kind of the recent trend for solar energy projects. Now, this would grant a sales tax exemption for certain energy storage systems. Last year, there was a lot of legislation relating to solar energy projects, and this just continues that trend. So I expect this will get a lot of support and probably pass. The next slide, just very quickly, is just an exclusion for in calculating the motor vehicle sales tax. It accounts for trade-ins. It's small, but probably affect a lot of people. And on the next slide, this one's a little bit of a head scratcher, and I'm not sure what to really think of it. This bill says that if you file your return on time, even though you don't pay your tax bill, that they will not assess a late payment penalty. So, I mean, it doesn't really seem like that's going to happen, but it's out there. On the next slide, this is kind of, as you would imagine, there's a lot of legislation relating to the coronavirus and relief. And I think this is, the first of a few slides that I'll show you. relating to a child care tax credit that they would give you, for expenses up to $1,000, and you can carry it forward 5 years as a result of the COVID pandemic. And on the next slide, this is also COVID related. Probably a lot of folks on this Zoom will probably like this. It's a credit for home instruction and private school tax credit. Now, the interesting thing about this is that you're not eligible for it if you didn't send your kids to private school or have homeschool last year before all this happened. So, that's probably going to take out a lot of people right there. Next slide is also, as you would imagine, a sales tax exemption for PPP, personal protective equipment. That falls in line with the exemption that is provided for medical equipment as well. So next slide, please. And this is another one. It's just, it basically broadens the sales and use tax exemption for data centers, and it reduces the job creation requirement in a distressed area. So there are things like this that I think the General Assembly is trying to do. I noticed that the Department of Taxation was pretty quiet earlier this year on granting relief for COVID-related items. There were some things about extending, deadlines and payments and that kind of thing. But in general, you have to ask the department for relief. So if you have a client who's having some difficulties with paying their bill or whatnot, it's always a good idea to reach out to the Department of Tax, and they will are usually pretty decent about granting accommodation when they can. So this gets into my thing on remote workers, and maybe next slide. I think we have a poll, maybe not yet. Oh yeah, so this is my question to everybody. Where are you working? I was hoping to see more people in a vacation home, but the early data is that nobody is at a vacation home. So, but yeah, it looks like that, a lot of people are obviously working from home, and, the projections are that pretty soon everybody's going to be, in the next year, that we'll have like 70% of the people working from home permanently. Okay, well, so the data settled. So it looks like it's pretty evenly split. So that's a little bit surprising that so many people are back, but that's great. And nobody's working from a vacation home. So I'm very sorry to see that. Next slide, please. Right. So the percentage of working permanently from home is expected to double in 2021. So I guess, I feel like most people are already working from home. I guess it will, although the data, their poll was a little bit split, I think it will show that as people get back to work, that maybe it goes from temporary to permanent. I don't know. And by 2025, 70% of the workforce will be working remotely at least 5 days a month. Next slide, please. So the taxation on this is generally that you pay income tax in the state where you reside, and your employer has to withhold in the state where you work. So this could create some issues if somebody lives in state A and works in state B. Then what they would do is file an income tax return in state A, and also file one in state B, and they would take a credit in state A for the amount they paid to state B. Some states have convenience of the employer test, in most of the northern states, Connecticut, Delaware, New York, PA. Other states have reciprocity agreements. Virginia has them with DC, Kentucky, Maryland, and West Virginia, and Pennsylvania. And that basically just means that you're only subject to tax in your home state. You're not subject to tax in the other state where you would work. So next slide, please. So if an employee is working in another state and is now working from their home state, there's really no change if the states have a reciprocity agreement. The employee would continue to be subject to withholding in their home state. So if you have somebody in Virginia who used to work in DC and is now just working from their home in Virginia, there's a reciprocity agreement that they would only be taxed in Virginia, so there's no change. If the employee works from home in a state that does not have a reciprocity agreement and they're working at home, then it's basically the same answer as above. They continue to get taxed in Virginia. Where you run into problems is if an employee is working in a state other than their home state or their principal work state, then the employee will generally be subject to withholding an income tax in the other state. Next slide, please. There are some jurisdictions like the ones that I've listed here that have provided have actually issued guidance regarding COVID and provided some temporary relief for this until we get out of it. But it was supposed to be temporary, and this was issued. Some of these items were issued like last spring and in the summer, and who knows how long we're going to be in this. So it might be more of a slow turn. Next slide, please. So there are some ancillary issues that kind of go along with this, and it's not just relating to like where you withhold on the employee or where they have to file taxes from a business perspective. And I'll go quickly through these, but you have the employee's presence in another state can create income tax nexus for you. States that use a 3-factor apportionment will obviously have payroll, and maybe different states now. Market source, as far as sourcing income for intangibles and services. It probably won't change too much for market-based sourcing states. However, it could create problems for cost of performance states now where you've got employees in different states working. So next slide, please. So some other issues that we have also are the sales tax nexus. And by the way, how great was it that Wayfair came out 2 or 3 years ago before all of this? The states would really be losing a lot of revenue if they didn't have the ability to tax online retailers. But the remote worker issue also creates issues with unemployment taxes. Where do you pay? You might have, likewise for labor and minimum wage laws, you might have an employee working in a different state now with a higher minimum wage. You have local tax laws. You could possibly have property taxes in many different jurisdictions now. It's easy, like, if you've got a company and they've got all their computers in their office, but, to figure out, how to, property taxes on their FF&E. But now if you've got employees that are working from different jurisdictions, you could, it's a little bit harder to tax. We've seen also questions come up with reimbursements or stipends for employees to get equipment and work from home. The reimbursements, the question, becomes, are they ordinary and necessary? The deductions for a home office, if you go out and buy your own home office equipment or a home office deduction, those are generally limited if you are an individual, because the Tax Cuts Act got rid of itemized deductions. So those are things to look out for that have crept up because of this. Next slide, please. So again, some states have announced temporary, guidance. The rules are very clear. Other states and localities have not. So in the absence of clear guidance, you have to really just assume that the normal rules apply and stay up to date on any rule changes. If you get to a point where you find out that you maybe should have done something and you didn't, then perhaps you consider different ways to get back into compliance. One might be through a voluntary disclosure if the issue is significant enough, or it could just be contacting the state and trying to work something out, or the locality. So I'm out of time. I'll now turn it over to Farhad so he can cover our wealth planning updates.
Thanks, Kyle. I appreciate that. And I'm just going to spend the next few minutes talking about some recent developments and some changes that have happened. If you go to the next slide, have the annual inflation adjustments. The estate and gift tax and GST tax exemption went up to $11.7 million this year, up $120,000 from the prior year. The gift tax annual exclusion remains at $15,000. If you may recall, because of the way the inflation adjustments are calculated for gift tax annual exclusion, you actually have to get to $16,000, and then it's rounded down to the nearest $1,000. But I'm hopeful that maybe in 2022, the exclusion will go up to $16,000, because if you look at the annual exclusion for gifts made to a spouse who's not a U.S. citizen, you'll see that it's $159,000. And so that tells me that we're right on the cusp that hopefully next year's inflation adjustment will pull us over. There's some additional amounts that are set forth based on Section 6166 or 2032A. If we go to the next slide, you'll see that the income tax brackets for 2021 have gone up slightly in terms of where you reach the top bracket for income taxation of trusts and estates. And the big takeaway, this is nothing new, is that the trust rates are compressed, so you get to the top tax rate very quickly at the 37% at $13,000 of taxable income. As I think many of the folks on this call know, there is an opportunity to do some income tax planning, and we're in that window. There's something called a 65-day rule, where during the first 65 days of a trust's tax year or an estate's tax year, you can distribute income and have that income distribution carry back to the prior year. So assuming you've got a calendar year trust, and you may not know what the trust income is, you have essentially until, I think, March 5th to calculate how much income was earned in 2020, make distributions during the 65-day window, make it's called the 663B election, and distribute that income and have it pass out to the beneficiary, and treat that as income for 2020 purposes. And really what you want to do is sort of look at what is the effective marginal tax rate for the beneficiary as opposed to the trust. And in many cases, it may make sense to distribute that income. So we're smack dab in the middle of that window. And I think particularly as you start getting your December account statements and you can really calculate how much income you have, it's something to consider. So I want to note that. If we go to the next slide, I want to mention one case that I thought was pretty interesting, came out towards the end of the year. And it's really less of an estate tax case, but it is for clients that are making charitable gifts. I think it's an important case to consider. It's Dickinson versus Commissioner. It's a tax court memorandum case. And in this situation, in this case, the taxpayer gifted shares of closely held stock to a Fidelity Charitable Donor Advised Fund. So they gifted shares of closely held stock, and they wanted to get an income tax deduction equal to the fair market value of the shares that they gifted. And that's probably why they gifted to a donor advised fund, because it is a public charity, and they would get a deduction equal to full fair market value. Fidelity has a policy that says basically whenever we receive closely held stock, it's our policy to basically tender the shares back to the company so we can get redeemed, because they don't want to hold stock in this closely held business. And so the question that came up is, does the assignment of income doctrine apply? What that essentially says is that if a person makes a transfer of an asset to a charity, but it's subject to a binding obligation to sell, then what under assignment of income, what it will really be treated as if the taxpayer did not make a charitable contribution, but really that the taxpayer sold the asset, realized the gain, and then made a charitable contribution of the proceeds. And that's a bad result because essentially the gain and the charitable deduction are offset, and really the taxpayer does not get the benefit of that income tax deduction. And the IRS pointed to that policy where basically Fidelity says, we're going to, our policy is to sell the stock and have it redeemed. And basically the taxpayer said, if you looked, or the tax court said, if you look at the documents that were signed, the taxpayer gave away the shares, absolutely. And they had no rights over the shares once they made the transfer. And any gain or income that was recognized occurred after the shares were in the possession of Fidelity. And so the tax court said that the assignment of income doctrine only applies when the sale is practically certain to occur and whether the shareholder made the gift or not. And so I think assignment of income doctrine comes up. This is somewhat unusual because really the taxpayer made the gift to the entity. What we often see assignment of income is where there's a transaction. So there's a larger transaction. There's there's going to be a merger. It's going to be a cash merger, and the question is, well, the sale is going to happen whether there's a contribution to the charity or not. And so that's just, I think, a distinction, whereas here, there really wasn't a transaction in play. This was just simply a gift. But so keep an eye on Dickinson. I think it's an interesting case. The next item is really kind of thinking about what are we going to do this year from a planning perspective, and want to offer a little bit of kind of what we've seen in an experience and maybe some planning that folks may want to consider for the balance of 2021. For a lot of us who work in the wealth transfer tax planning space, the last quarter of 2020 was extremely busy. We had a lot of clients who were making gifts in 2020 with the idea that they wanted to use up their gift tax exemption before there's a potential drop in 2021. You know, we were doing a lot of these gifts, but we didn't know what was going to be the outcome based on the Georgia Senate elections. And now we know that there's essentially going to be, there's a 50-50 split with Vice President Harris breaking the tie, so the Democrats have control of the Senate. But I would say that the 2020 elections really narrowed the margins, both in the House and the Senate. The House margins are a lot narrower. And, you know, while there are Democrats, you know, there are also very conservative members of the Democratic caucus. I think Joe Manchin in West Virginia has been pointed out. I would also say Senator Mark Kelly, who's from Arizona, is up for re-election in 2 years because he was elected to fill a vacancy. So, and I think Arizona is a relatively conservative state, a lot of retirees. So increasing estate taxes may not be terribly popular there. And so my view is they may hold the keys to what happens in the Senate. There's the possibility of a repeal of the filibuster rule. I think there was a little bit of a breakthrough yesterday where a number of folks, including Joe Manchin, said that they did not support a repeal of the filibuster. And then there's always the possibility of pushing tax legislation through in a reconciliation bill. So a reconciliation bill can be done once a year, and rather than requiring the vote of 60 senators, you only need a 51-49, so a straight simple majority. And you know, there is the possibility of pushing through tax legislation that's attached to a reconciliation bill. The 2017 Tax Act, so the Trump tax cuts, were part of a reconciliation bill. Some of you may have seen yesterday, there was a report, it was reported this morning, of Mark Mazur, who's the Deputy Assistant Secretary of Treasury for Tax Policy, spoke at the ABA tax section meeting and shed some light. And I think this is probably some of the more definitive guidance that we've actually gotten from the administration, as opposed to people like me and other folks out there just sort of speculating on what may happen. He spoke at the ABA tax section meeting, and the tax notes article, I think, was really helpful. There's a lot of good detail. A couple of the things that he said was, one, he does not think that tax increases will happen in the near term, given where we are with the economy. I think they're going to obviously focus on, you know, pandemic relief, COVID, economic support, those kinds of things. Second thing he said is that retroactivity is not likely unless these tax provisions are enacted early in the year. And so I think the idea is there's a certain sense of fairness, but also just changing behavior. But if you think about his first comment that tax increases are not likely to happen in the near term, then I sort of read that to say, well, it's unlikely that we'll have retroactive changes this year. Now, there are two types of changes. I mean, in broad, from the estate tax perspective, there's change in the exemption and there's changes in rates. I think it's probably less likely to see a change in the exemption, but it certainly could happen. I think it's perhaps more likely to see a change in rates. That's what happened in 1993, where they actually increased the estate tax rate from 53 back to 55%. He also talked about enactment of legislation through reconciliation and said that that was actually pretty disfavored, really because, you know, very often reconciliation, tax legislation that's part of reconciliation is hastily drawn, and there's often technical fixes, and it's just not a good way to push through legislation. He also mentioned that they're going to issue a green book, which is sort of the, I call it sort of the Treasury wish list, sort of the Christmas list of all the things they'd like to see. A lot of those things are just wish lists and won't see the light of day, but it does give us good guidance in terms of where the administration is headed. The last administration did not issue a green book. The new administration will, which I think is helpful. So In terms of what we've heard things talk about is dropping the estate tax rate to $3.5 million, having the gift tax exemption at $1 million, and increasing the tax rate to 45%. They've also talked about repealing the Section 1014 basis adjustment of death, sort of we call the step up in basis, although it could be a step down. What some of the proposals are really revenue raisers is, one, taxing the unrealized appreciation of assets upon gift or transfers at death, which is more than just repealing the step up in basis, is actually creating a capital gain event at death. And I think that I'm not sure how much support there would be. And as I said, the real question is if they pass something in 2021, will it be retroactive? And obviously we don't know. If we go to the next slide, clients have asked us, well, we are concerned about what happens if I make a gift in 2021 and they change the law. Is there a way to protect myself against, maybe my exemption, making a gift now, but then they reducing my exemption, and all of a sudden I've made a taxable gift? And I think there are a number of strategies. I think one strategy that I really like is, perhaps having a client create a gift assets into a trust, where initially the asset would be held in an inter vivos Q-tip trust. It's a marital trust, it's a trust, it's a lifetime Q-tip trust. It's all income is paid to the spouse for life. You could have principal distributions, could give them a power of appointment. The nice thing is that in order to make the Q-tip election, you would do that on a gift tax return that would need to be filed next year, and potentially as late as October 15th of next year. And so really you have the benefit of, frankly, watching the movie and seeing what's going to happen during the duration of 2021, and then deciding what you want to do from a tax perspective. If they don't make any changes to the tax laws, then you don't make the Q-tip election. You use up the client's gift tax exemption, and that works great. If they change the law retroactively, then you make the Q-tip election and you've made basically a marital deduction type transfer, so you haven't used the exemption. So it gives you a lot of optionality. The other thing that I like is you also have the benefit of giving or building in the flexibility of giving the spouse the option to disclaim assets. So the assets go into the marital trust, and as long as the spouse does not accept or use any of those assets before they execute a disclaimer, they could disclaim, and then the assets could actually go into kind of a traditional inter vivos family trust, spousal lifetime access trust. So I think that's some kind of interesting planning that folks may want to consider and think about as they're planning and doing things this year, particularly during this period of uncertainty. If we go to the next slide, this is really the poll, and the question is, what do you think will happen this year? Will we see any changes in the tax laws? No changes. We will see changes, but it will be effective only prospectively. We'll see legislation that's enacted in 2021, but effective in the future, so in 2022. Or do you think it'll be retroactive to the beginning of the year? Give it a few minutes to see. We're seeing it's interesting. You're seeing very low support for retroactivity, which I view as positive. And then I would say probably seeing folks think that we may see something this year, but it would be effective prospectively. And then some dealing with effective date. So it looks like the winner was enacted in 21, but effective prospectively. So I think that is the extent of my comments, and I appreciate it. I'm going to turn things over to Anna, and she'll cover some additional international tax things. Thank you.
Hi, everyone. So our last topic is actually going to be Section 1202, Qualified Small Business Stock, or Qsbs. And this is less of a technical guidance update and more of an issues update, because we're seeing a lot of questions around this topic. So I'm kind of curious to see who else is seeing issues with this. So Stephanie, can you bring up our polling slide? So the poll question is, have you dealt with Section 1202 Qsbs stock in the last year? Okay, and so it looks like we are split fairly evenly, but with maybe the majority of folks not having dealt with it. So I'll set the stage a little bit and then sort of dive into some of the issues that we're seeing. So 1202 provides a great incentives for taxpayers who are investing in small business C corporations, because it allows them with the potential to exclude 100% of the gain of the sale of their company's stock. And that 100% exclusion may be reduced for depending on when the stock was acquired. But for stock that was acquired after September 27th, 2010, there is a potential for 100% exclusion with the caveat of the individual limitation. And if we can go to the next slide. So the maximum amount that could be excluded is limited to the greater of $10 million, or essentially 10 times the taxpayer's adjusted basis in the stock. So if we can go to the next slide, we have a quick example just to set the stage. So let's say on January 1st, A buys 100 T common stock for $500,000 cash. After holding it for 5 years, which is the minimum holding period that you need in order to be able to access 1202, A sells their T shares in year 6 for $25 million. So without 1202, they would have capital gain of 24.5. If we apply 1202, they may be able to exempt some of that gain. So the amount they're able to exempt is the greater of 10 million, or 10 times their basis. 10 times 500,000 is 5 million. The greater of 10 million or 5 million is 10 million. So A may be able to exempt up to 10 million out of that 24.5. So that's a pretty significant benefit. And combined with the reduction in corporate tax rates that we had as a result of the 2017 Tax Act, and people thinking that maybe the rates aren't, going to go up at least back to 35%, we've seen a lot of people be very aggressive in getting startups to organize as C corporations or to convert into C corporations. And of course, in order to get these benefits, you might expect that the IRS put in some very strict requirements as to qualification. So Jen, if we can go to the next slide. So in order to qualify as Qsbs, the stock has to be issued by a domestic C corporation with no more than 50 million of gross assets at the time of issuance. It has to be issued by a corporation that uses at least 80% of its assets in a qualifying trade or business, issued after August 10th, 1993, held by a non-corporate taxpayer, and acquired by the taxpayer on original issuance of that stock. And so for your reference, you'll be getting a link to the slides. All of those factors and requirements are described in a little bit more detail in the subsequent slides, but given the short amount of time that we have and the fact that we're seeing a lot of questions around the original issuance question, I'm going to stay right here for the rest of my time. So the key, and I think that we're getting those questions because we're getting a lot of situations where somebody formed as an S Corp and an LLC because that may have been, the advice a couple of years ago. People want the flow through status, but now they're saying, hey, I just found out about 1202 and everybody's doing this 1202 thing. How can I get the benefits of this? How can I convert into C Corp status? And that really brings up this original issuance question. How can you convert into C Corp status and get an original issuance of stock? Because the rule is that you need to, the taxpayer shareholder needs to acquire the C corporation stock in exchange for money or other property, excluding stock, or as compensation for services rendered. So, for example, if I have an S corporation and I want to convert that S corporation into a C corporation, how do I do that so that I can access the 1202 benefits? Can I just terminate the S election? Will that work? No, because although you may have been originally issued stock of the corporation, it was an S corporation when it was issued. So you can't just terminate it because there's no sort of deemed reissuance of the C corporation stock when an S terminates its election and becomes a C. Well, can I merge into a C corporation and or do another tax-free reorganization into a C corporation and get 1202 benefits that way? The likely answer to that is also no, because again, you need to receive your Qsbs in exchange for money or other property that is not stock. So you can't exchange bad stock for good stock. Congress isn't going to be nice enough to let you just structure easily into 1202 when you've held bad stock. But if you started out with 1202, they will let you keep that status. So for example, you could exchange good stock for good stock, or perhaps even good stock for bad stock, although the amount of gain that would be eligible for the 1202 exclusion would really be just the gain that that was appreciated through and until the exchange when you got the bad stock. One other exception that I have seen to this and that I will throw out for your consideration is a lot of times when companies are merging into C corporations, it's because there is a new investor coming in that wants to be in a C corporation. And also that new investor not only wants to be in a C corporation, but they want to have the founders of the S corporation or the prior business issued new shares that have restrictions on them. So the founding shareholder ends up exchanging substantially vested shares for substantially non-vested shares. And there's a revenue ruling, 2007-49, that says in that circumstance, for 83B purposes, the unvested stock that is received is treated as received in compensation for services rendered. So the question is, can you expand the application of that ruling to apply not only to Section 83, but also to 1202? So now instead of having a situation where the founding shareholder is deemed to exchange stock for stock, they're deemed to exchange vested stock for non-vested stock, and that non-vested stock is actually treated as received as compensation for services rendered. So you do actually meet the original issuance requirement. That may be something to throw out there, but it may be a pretty unique circumstance. So if you can't terminate your S election, you can't reorganize easily into a C corporation, maybe you can have the S corporation drop some assets and some business into a C corporation because individual shareholders can own Qsbs stock through a pass-through entity. How you do that, of course, as you might expect, has its own limits and care that you have to do in structuring that. But that may be a planning alternative for them. But one thing that I would throw out there in that situation is to be careful of the timing, because when you contribute property that has fair market value that is greater than its basis in exchange for Qsbs, ordinarily your basis in the Qsbs would be the basis of the property that you transferred. However, for 1202 purposes, your basis will be the fair market value of the property. And so what that effectively does is allow you to capture only the gain that is appreciated after conversion into C Corp status under 1202. And so that also makes sense from a policy perspective, so that you can only take advantage of 1202 for the gain that's created while it's a C corporation. If you have, instead of an S corporation, if you have an LLC that you're trying to convert, that may be a little bit easier, if that's something that you will complete under a state law conversion. It may be it's a whole different ballgame, because then typically the deemed tax consequences of that are that you are either you're contributing some form of property to this new C corporation that you've converted into, either the partnership or LLC interests or its underlying assets. And so then you are contributing money or other property that is not stock in exchange for Qsbs. So you have to be very careful of what type of entity you have, and is it an S corp, is it an LLC, and where you're trying to get to. And they may have different non-1202 tax consequences as well. So some LLCs may be very, very heavily debt financed. And with not many assets if it's a startup entity. So they may have liabilities in excess of their basis, which means that if you then contribute those properties to a C corporation of 351, you may end up with 357C gain. So you have to be careful of sort of non-1202 issues. And then once you've gotten past all of sort of even just getting the original issuance, if the taxpayer is anticipating a sale, will they, after the conversion, then be able to hold the stock for 5 years? So you can't convert, sell in a couple of months. That's not going to work. But if it's something that you're maybe looking at, taxpayer structures right now, it may be something to assess whether this is a path that you want to go down, if the growth potential is still there. Now may be a good time before you have an immediate sales event on the horizon. And then, of course, once you get past this issue, you have all of the other issues to go through too. So is the corporation still worth less than $50 million? Do you still have the right active trader business? So obviously a lot of issues that we can't cover in 10 minutes, but maybe we'll say for a future tax forum, or and be able to cover it in a little bit more depth, but just wanted to sort of share some of the issues that we're seeing. And it's mainly around people wanting to go into these 1202 structures and trying to figure out how they're going to get into them. And as Jenny's flipping through the slides, you can see that there is some additional detail on some of the other requirements in there. But I think that's our time for today. So I will flip it back to Jenny and let her finish us up.
Thank you all. That concludes today's presentation. Unfortunately, we have run out of time for questions, but if you have submitted one, we will reach out to you individually as soon as possible. As we said before, please look for an email from Williams-Mullen that will certify CPE attendance, and we will also follow up on the CFP attendance. The email will also include presentation materials that you saw today. Thank you again for joining us, and everyone, please stay safe.